So that's a significant move in bond markets actually. Yields are down by around 13 basis points to 7.43, 2027 government bond that we are talking about. And the news which is coming in, government has cut down on additional borrowing. Ira joins in with more details. Ira, what's the update?
This has been tweeted out, Pradeep, by the DEA secretary. So we don't see it out on PIB or on the RBI's official website yet. But Subhash Chandra Garg has tweeted out from his official account saying that the government has reassessed its additional borrowing requirements, taking note of revenue receipts and expenditure patterns. Requirement of additional borrowing, which had been pegged at 50,000 crore. This was additional borrowing through dated securities, is now being notified at 20,000 crore. So if you go by this tweet and assuming that this will be put out on the PIB formally and then followed up with the Reserve Bank of India's notification as well, they have cut down on the additional borrowing, the gross borrowing, by 30,000 crore. Remember, the earlier number was the gross borrowing after the addition was at 6.1 lakh crore. So now they've reduced it by 30,000 crore. So you're down to about 5.8 lakh crore on the gross borrowing amount for the current year. Big relief coming in for the bond markets. Not surprised because of the way in which bond yields had moved. Even though when they first announced their additional requirement, they had tried to do some jugglery with words, saying that, we are reducing the T-bill outstanding. So the net borrowing in the additional period, Jan to March, is not higher than what the earlier net borrowing was. But the market had not believed any of that. They had discounted all the jugglery on the T-bill side and focused on the net, on the gross additional borrowing by dated securities, which was at 50,000 crore. Yesterday, of course, bond yields went up even further for a completely separate reason, which was a speech given by the RBI Deputy Governor. But it looks like, taking into account the rise in yields, the government has decided to reduce that dated borrowing amount from 50,000 crore to an additional 20,000 crore. Should be a big relief. I think 10-13 basis points is the drop that you're seeing in yields already. We will try and get a view in from the bond markets to see how they are reading this. But this will be the big relief because apart from, of course, fears on the fiscal side, the borrowing number had really spooked markets. I believe Mr. Sivakumar of Axis Mutual Fund is with us on the phone line. Good morning, sir. What do you make of this? This hasn't come out officially on PIB, but the DEA is tweeting it out from his official account, saying that the gross amount is now 20,000 crore, not 50,000 crore.
I think it's clearly a reaction to the pressure on rates. We've seen since the end of the year itself more than 20 basis points sell-off, which is just over the last couple of weeks. And the new benchmark, for example, is trading at the same level that the old benchmark was at the end of end of December. So clearly there is a lot of pressure on the government, and they have responded by cutting, or it appears that they may have cut the additional borrowing amount. We must also remember that 2 auctions have already been partially cancelled, and that itself is a signal that they have been forced to reduce the borrowing number just to adjust to the appetite from the market.
Assuming that this 20,000 crore number is what we need to go with, what does the borrowing math now look like? I think when the additional borrowing was announced, we said 50,000 crore dated securities and about 25,000 crore additional on T-bills. So now it's 20 plus 20, 25?
So we need to see the final numbers on the treasury bills. The government's own fiscal math should not have changed. It is possible that they may have altered the mix with respect to dated securities and treasury bills. Given the amount of liquidity in the system, which is the upcoming maturities of over 1 lakh crores of MSS bonds, we know that the treasury bill demand should pick up over the next couple of months, and therefore, if they substitute the long bonds with T-bills, the market should be able to absorb it easily.
All right, so just stay with us on the phone line. Neeraj Gambhir of Nomura is also joining us for a quick thought. Thanks, Mr. Gambhir, for taking our call. What do you make of this, from 50,000 crore on dated to 20,000 crore? That's all we know, and we know it from the Twitter account of the DEA secretary.
So that's, if this is true, then it's actually quite a positive development for the market, because the market was weighed down quite a bit with this additional supply that the government had announced, and yields had actually risen up quite sharply. And the immediate reaction has been that the bond yields have actually, come off by approximately 10 to 12 basis points. I think the whole issue was that market did not have the appetite to absorb this additional supply and given the overall economic environment, given the inflation trajectory and the rising crude oil prices, there wasn't really that much appetite. So this sort of addresses the demand-supply mismatch that was being created, and this is certainly going to be positive for the bond market.
All right, Neeraj, thanks so much for that quick reaction. Siva, I'm just going to come back to you for a thought, partly facetious, but not entirely. The government maybe, or perhaps with this move, undoes some of the damage that Viral Acharya's speech to the FIMDA Association had done on Monday, where he had signaled, and I don't know if it was the right signal that markets picked up or not, that the RBI is not keen to keep intervening to manage interest rate risk on behalf of the markets. Yields had shot up again yesterday. Well, not directly in response to it, but this undoes some of that pressure, perhaps?
Well, it does, and but I think this is not directly a response to the Deputy Governor's statements. I think it's more of a response to the fact that the last few auctions have struggled to clear. We have had 3 auctions back to back, 2 of them with cancellations and another one where the results came very late, pushing the trading hours out by an hour. So what that suggests is that the RBI and government have found it very difficult to sell the amount of G-Secs on offer, and there's a discomfort in paying these yields. So in a sense, the cancellation of auctions earlier as well as this reduction is a signal both from government and RBI that they're uncomfortable with the level of yields and are trying in a sense to send also a yield signal to the market that they want yields to soften a bit.
All right, Mr. Sivakumar, thank you so much for joining us with that quick view. Big move in yields already, I think 10, 13 basis points down. I'll hand it back to you, Pradeep. I presume bank stocks are also moving up on the decline in those yields.
Yeah, so Nifty Bank has recovered, and some of the heavyweights like Punjab National Bank is one that I have seen moving up. ICICI Bank is also higher by around 2.5–3% now. So almost 1% move that we have seen in ICICI also in last 15 minutes. Since the news came in, you also have such movement in IDFC Bank. IDFC has gone up. Capital First has improved. Bank of India, Indian Bank. So whole host of stocks actually. In fact, private banks and NBFCs had corrected yesterday. So now you see the trade in the other direction. These stocks are recovering. Maybe some amount of short covering at some of these counters that are present in FNO is possible. So Nifty Bank is the one that was kind of a drag on the market, on Nifty. And now with this key development, you look at Nifty Bank has once again crossed 26,000 mark, is quoting above that. And that's good news coming in, a relief not only for bond market, but for equities as well.